Hello, this is Dr. Moultrie. This is the video, actually, let's start all over. Hello, and welcome to part 2 of chapter 2, Introduction to Financial Statement Analysis. Hi, my name is Dr. Moultrie. So in this video, we will cover the topics, the income statement and the statement of cash flows. The income statement serves as a comprehensive overview of a company's financial performance over a specific duration, in which it details both its revenues and expenses. Often known as the profit and loss or P&L statement. Now, this financial document, the income statement, concludes with the bottom line, which indicates the net income. And we all know that net income, sometimes referred to as earnings, it stands as a key measure of a company's profitability during a stated period. It actually encapsulates the outcome of the firm's operational activities by revealing whether it has generated a profit or if they incurred a loss. The income statement provides stakeholders with valuable insights into the financial health and the viability of the business, aiding them in informed decision-making. Here on this slide, you see the earnings calculation. You have the gross profit, which is revenues, net sales minus cost of sales is equal your gross profit. The operating expenses, you have the operating income is actually the gross profit minus operating expenses. And then you have what we call the EBIT, which is also earnings before interest and taxes. It is the operating income plus or minus the other income, which will give you the EBIT. And then you have the pre-tax and net income. The pre-tax income is actually the EBIT or EBIT plus or minus the interest income or expense. And then you have your net income, which is pre-tax income minus taxes. Here you see table 2.2, the Global Corporation's income statement sheet for 2022 and 2021. You see in 2022, the operating income, well, the gross profit was 33.3, and in 21, it was 28.8. And here at the bottom, you see the operating income. At the end of 2022, it was 10.4, and then in 21, it was 7.1. Here's a continuation of the income statement for Global Corporation. You have the EBIT at 7.1, I'm reading from right to left. And then in 2022, it was 10.4. Pre-tax was 2.5. In year 22 was 2.7. And then you see the net income in 21, it was 1.9. And the net income in 22 was 2.0. So the earning per share, or EPS, it is a crucial financial metric that gauges a company's profitability on a per share basis. It is calculated by dividing the company's net income attributable to common shareholders by the average number of outstanding shares during a specific period. So you have your earning per share is equal to your net income over your shares that are outstanding. Okay, and then you see where the net income was 2 million, the shares outstanding was 3.6 million. So it was 56 cents per share. The EPS, or the earning per share, again, when fully diluted, it takes into account potential additional shares that could be issued. Now, this includes shares arising from stock options granted to employees, which represent the right to purchase a specified number of shares at a predetermined price within a defined period. Also, the fully diluted EPS, it considers the impact of convertible bonds. Now, these are corporate bonds that carry a provision enabling the bondholder to convert each bond into a fixed number of common stock shares. The fully diluted EPS provides a more comprehensive picture of a company's earnings potential, and it factors in potential share that will increase from these financial instruments. The EBITDA stands for earning before interest, taxes, depreciation, and amortization. Now, this is a financial metric that is used to assess a company's operational performance by measuring its profitability before accounting for non-operating expenses such as interest on loans, taxes, depreciation of assets, and amortization of intangible assets. Now, the EBITDA provides a clear picture of a company's core operating profitability, which allows for better comparisons between different firms or industries by excluding non-operating factors that may vary, among companies. It is also commonly used in corporate finance and valuation to gauge a company's earnings potential. The statement of cash flows. Now, the statement of cash flows is a vital financial document that relies on data from the income statement and balance sheet to ascertain over a specific time frame the amount of cash a company has generated and how it has been allocated. The statement of cash flows is crucial because it provides insights into the operational cash flows, investing activities, and financing activities of the firm. Now, we all know that cash is a lifeline for businesses because it is essential for meeting financial obligations. It's important because it sustains the day-to-day operations, and it serves as a source for any potential return on investment for investors. By delineating the sources and uses of cash, the statement of cash flows plays a pivotal role in offering transparency and understanding the cash dynamics within a company. The statement of cash flows is segmented into 3 distinct sections, which of course aligns with the primary responsibilities of financial managers. The first section you see is the operating activities, which outlines the cash generated or used in the company's core business operations, reflecting the financial manager's role in managing day-to-day cash flow. The second area is the investment activities. Now, the investment activities details cash flows related to the acquisition or sale of long-term assets, which also aligns with the financial manager's duties in managing investments and capital expenditures. And the third area is the financing activities. It is the cash flows that are associated with the company's financial or financing structure. And it includes debt and equity transactions, which mirrors the financial manager's responsibility in securing and managing the company's capital structure. Now, this breakdown is the statement of cash flows. It provides, again, a comprehensive view of how financial managers address key aspects of a company's cash dynamics. Here you see in table 2.3 is Global Corporation Statement of Cash Flows for 22 and 21. Year ended December 31st. So you see here the operating activities. You have your net income, depreciation and amortization, cash effect of changes in accounts receivable, accounts payable, inventory, and then you have the cash from operating activities. Here's a continuation of that same statement. You have the investment activities, capital expenditures, acquisitions and other investing activity, financing activities, dividends paid, sale or purchase of stock, increase in short-term borrowing, increase in long-term borrowing. Then you have your cash from financing activities and change in cash and cash equivalents. Now, in the context of the operating activity section in the statement of cash flows, adjustments are made to account for changes in working capital, specifically focusing on accounts receivable. Now, when there is an increase in accounts receivable, we would deduct this amount from the cash flows. Now, this adjustment is essential because the rise in accounts receivable signifies additional credit extended to customers by the company, essentially acting as a form of lending. However, it reduces the immediate cash available to the company. Therefore, by subtracting the increases in accounts receivable, we accurately reflect the impact on the company's cash flow, providing a clear understanding of its operating activities and overall financial health of the company. Again, in the operating activities section of the statement of cash flows, Adjustments are made to account for changes in working capital with a focus on accounts payable. Now, when there is an increase in accounts payable, we add this amount to the cash flows. This adjustment is crucial because an increase in accounts payable signifies additional credit received by the company from its suppliers. So in other words, it's borrowing. So this borrowing increases the immediate cash available to the firm. Therefore, by adding the increase in accounts payable, we accurately reflect the impact on the company's cash flow, providing a more comprehensive view of its operating activities and financial position. In the operating activity section, adjustments are also made for changes in working capital related to inventory. When there is an increase in inventory, we deduct this amount from the cash flows. Now, it's important to note that although increases in inventory are not recorded as expenses and they do not contribute to the net income, they do represent a cash outflow from the firm or for the company. Therefore, we deduct the cost of increasing inventory to accurately reflect the impact on the company's cash flow. Also, what we would do is that we add back depreciation to net income in this section since it is a non-cash expense and it does not involve an actual cash outflow. This adjustment ensures a more accurate portrayal of the firm's operating activities and cash position. In the investment activity section of the statement of cash flow, we focus on subtracting capital expenditures made by the firm or the company. Now, capital expenditures represent investments in long-term assets like equipment or property. So by subtracting these expenditures, we account for the cash used in these investment activities, providing insight into the firm's commitment to its long-term growth. We also would deduct other assets purchased or investments made, such as acquisitions, as they also involve cash flows. Now, this section helps us to understand how the company is deploying its resources for future growth and expansion, which ultimately offers valuable information to investors and analysts assessing the company's strategic decisions. In the financing activity section of the statement of cash flows, we focus on the sources and uses of cash related to the company's financing decisions. Now, this section, the financing activity, provides insights into how the company raises and deploys capital. Key components include dividends paid to shareholders, which represent cash outflows, and cash received from the sale of stock or spent repurchasing its own stock, which denote cash inflows or outflows depending on the activity. Also, changes in short-term and long-term borrowing are included, reflecting the firm's borrowing and repayment activities. So understanding these financing cash flows is important for investors and analysts assessing the company's capital structure and financial health. It helps them make informed decisions about the company's stability and future prospects. Here you see the formula for retained earnings, the payout ratio and retained earnings. So retained earnings is equal to net income minus dividends, and the payout ratio is dividends divided by net income. The last line of the statement of cash flows combines the cash flows from these three activities to calculate the overall change in the firm's cash balance over the time period of the statement. I just read from the slide. Here you see an example 2.3, the impact of depreciation on cash flow. Here's a problem. Suppose Global had an additional $1 million depreciation expense in 22. If Global's tax rate on pre-tax income is 26%, what would be the impact of this expense on Global's earnings? How would it impact Global's cash at the end of the year? Okay, so depreciation is an operating expense. We know that. So Global's operating income, the EBIT, and pre-tax income would be affected. With a tax rate of 26%, the Global's tax bill will decrease by 26 cents for every dollar that pre-tax income is reduced. In order to determine how Global's cash would be impacted, we have to determine the effect of the additional depreciation on cash flows. Recall that depreciation is not an actual cash outflow, even though it is treated as an expense. So the only effect on cash flow is through the reduction in taxes. So we would execute it this way. Global's operating income, the EBIT, and pre-tax income would fall by $1 million because of the $1 million in additional operating expense due to depreciation. This $1 million decrease in pre-tax income would reduce Global's tax bill by 26% times 1 million is equal to 26 cents. Therefore, net income would fall by $1 million minus 20.26 equal 0.74 million. On the statement of cash flows, net income would fall by $74 million, but we would add back the additional depreciation of $1 million because it is not a cash expense. Thus, cash from operating activities would rise by 0.74 plus 1 equal $0.26 million. Therefore, Global's cash balance at the end of the year would increase by 0.26 million, the amount of the tax savings that resulted from the additional depreciation deduction. How would evaluate the increase in cash balance comes completely from the reduction in taxes because Global pays $0.26 million less in taxes, even though its cash expenses have not increased. It has $0.26 million more in cash at the end of the year. Here we have another problem. Suppose Global wants to accelerate its depreciation method so that it can generate $2 million in cash. So if the tax rate is 34%, how much additional depreciation expense would it need to generate the extra cash? With the tax rate of 34%, Global's tax bill will decrease by 34 cents for every dollar that pre-tax income is reduced. In order to generate $2 million in extra cash, Global would need to increase cash flow from operations. That's NI plus depreciation by $2 million. So cash flow from operation equal EBITDA minus depreciation. Then you have the 1 minus T plus depreciation equal EBITDA 1 minus T plus T times depreciation. Since there's no change in EBITDA because of additional depreciation, T times depreciation must equal $2 million. To execute, 0.34 times depreciation is 2 million. Depreciation is 5.8 million. This 5.88 million decrease in pre-tax income would reduce Global's tax bill by 34% times 5.88 million equal $2 million. Therefore, net income would fall by 5.88 minus 2 equal $3.88 million. To execute this on the statement of cash flows, net income would fall by 3.88 million, but we would add back the additional depreciation of 5.88 million because it is not a cash expense. Thus, cash from operating activities would rise by negative 3.88 plus 5.88, which give you 2 million. Thus, Global's cash balance at the end of the year would increase by 2 million, the amount of the tax savings that resulted from the additional depreciation deduction. So to evaluate, the increase in cash balance comes completely from the reduction in taxes because Global pays $2 million less in taxes, even though its cash expenses have not increased. It has $2 million more in cash at the end of the year. And this is the end of part 2.